So here we are. Following information has been extracted from the books of Picklette for the year to 31st March 2009. Administrative expenses, interest paid, share capital, dividend, cash at bank, hand in hand, income tax, the remaining balance from previous year. That means you need to pay. Warranty provision is given, distribution costs, land and building. In that land element, building element is given, and only this will get depreciated. So accumulated depreciation of building is given. Plant and machinery cost, it's accumulated depreciation, retained earnings opening balance, loan note, that means they have taken loan, purchases, sales, inventory, opening inventory is given, trade payables, trade receivables. This is the extra information given. Inventory, closing inventory, already will always be given in trial balance, adjustment, sorry. This is the end of the year. So this is closing inventory, ending inventory. We will consider this in the calculation of COGS or cost of sales. Buildings and plant and machinery are depreciated on straight line basis. No scrap value. This is the rate of depreciation. There were no purchases or sales of non-current assets during the year. And what is their practice with respect to depreciation is whatever depreciation we calculate here, the depreciation is to be divided in this manner. Okay, 60% to cost of sales account, 20% would go to distribution cost, and 20% to administrative. Income taxes, they have made an estimate for the current year. Loan note, they will pay in 5 years' time. Warranty provision, already opening balance is given in the book, and they want to keep it to 75. So they want to reduce the provision. Reduction in provision by 15 is reduction in liability, or it was an over provision. Now they want to reduce the provision. So reduction in provision is reduction in expense. So we will subtract this from the expenses. See what happens. Let's say, for example, the provision was 75 and now they want it to be 90. They want to increase the provision. So increase in provision is increase in liability, and you have to add 15 to the expenses because it increases the expenditure. But when the provision is decreasing, they had a higher provision. Now they want it to be only 75. They want reduction in provision. Reduction in provision is reduction in liability. You want to reduce your provision expenses, it seems. The estimation of provision, what you have done, you want to reduce it. So when you reduce the provision, it decreases your expenses because now you need to only settle your future warranty claims because you're making warranty provision, right? By $75, okay, not by $90. So your warranty claim expenses will reduce by 15. And you only write movements in the statement of profit or loss, because this is a liability, this is a liability, these are shown in liability side of balance sheet, but the movement, the difference in them is shown in the SOPL. So if you are increasing the provision, it is increasing the future estimates and increasing the expenses in the coming future to settle the claims. So there is an increase in expense in this case. But in our case, in our question, we are reducing the provision, so future expenses will reduce. Okay, by how much? 15. So we need to reduce our expenses by 15, because we are decreasing our estimates of provision, or future liabilities we are decreasing. It's intern like income, but it's not exactly an income. We don't write in the income side. We reduce our expenses. That's it. That's the treatment regarding this. Once I will show the question to you, you need to read it once again. We will solve the whole question. I'll scroll it down. Okay, let's start. Let's make this. First, we'll start with revenue. Sales less cost of goods sold, opening stock given to you 150, less purchases, 470, minus closing stock, 250. But cost of goods sold will have one more adjustment. That is, depreciation charges for the year 31st March 2000 at the end of the year are to be apportioned as follows. That means you have to show depreciation in this manner. Whatever depreciation you calculate for this year, 60% has to be shown in cost of sales. So let's do the depreciation part. Land, buildings, plant and machinery. What is their cost? 110, 1 lakh, and 1 lakh 20. We will remove the accumulated depreciation from the building element. It won't get depreciated. 75. Accumulated depreciation is nothing but till now the depreciation of the asset. What is that? Till now the asset has got depreciated by this much. And the current year depreciation would be what? This is accumulated depreciation. Current year depreciation would be, we'll just calculate. We'll apply the rate of depreciation. What's the rate of depreciation given? 5% on buildings, 20% on plant and machinery. As you know, this is a straight line method. The depreciation is calculated directly on the asset cost, not the carrying amount. Carrying amount, you do that in the case of diminishing balance. See, in case of diminishing balance, you will remove all the accumulated depreciation. You will remove all the accumulated depreciation till date, and on the balance amount you will be calculating the depreciation. You'll be applying the rate of depreciation. But here on straight line you directly apply on the assets original cost, not on the written down value or the value after deducting the accumulated depreciation amount. Okay, should be very clear. Now, so 5%, 20%, let's do that. 5% of this will be 5,000. 20%, 20% of 1,25,000 will be how much? 25,000. So total assets are how much here? 48 plus 75. Now you have to add assets carrying amount to be shown in the balance sheet. Land, however, not doesn't get depreciated. $52,000 minus 5,000, 47,000. Now, so we've got everything. Now, what we have got the depreciation for the current year, we need to take the 60% of this. 60% of this will go in your cost of sales account. Since it's an expense, expense will increase the expense. Sixty percent of 30, how much is that? 18. Just add all the amounts. Plus 470. 250. 250. 352. 150 plus 470 minus 250 plus 18. 388. This is my cost of sales. Now 1300 minus 388 is 912. That is my gross profit. Now less distribution cost. So you remember distribution cost is how much? 240. But we need to take the depreciation also. What they have given with respect to depreciation, 20% should go in distribution cost. So we'll do that. So 240 plus 12, 20% of 36, sorry, 246. 246. Administration expenses. 170 plus depreciation 20%. And I have already told you about the warranty provisions. Warranty provision, we need to reduce our expenses by 15. We'll put in administration because no other expenses given now apart from administration. That means no other expenses. You only have two expenses here. One is distribution and one is administration. That's it. These are the two expenses, operating expenses. So we'll remove warranty expenses minus 15. That is reduction in warranty provision. It reduces your expenses. I'm reducing the expense. So 20% of 36, 176 minus 15. So 15 is reduction of provision. It reduces the expense. From 90, we have made it to 75. So 912 minus 246 minus 161. It is 505. Next, there is a finance cost. 10% loan note issued. Interest paid. So 5 is what? Actually, total expenses for us would be 80 into 10%, 8. So what we are showing, we have paid the interest of $5. Actually, we have to pay $8. So $5 we have paid, $3 is outstanding interest. That means actually $8 is to be paid. So we'll show $8 expense. $3 will show in liability side of balance sheet. Finance cost, which is interest paid. So that is 8. We get PBT. Profit before tax, less tax. Now tax, what they have said. Income tax, remaining balance from previous year is 10. Okay. This has to be paid this year. This is previous year balance. Income tax remaining balance from previous year. So we need to settle this. This we need to settle, and this year's tax, how much? Income taxes for the current year estimated is 135. That means opening balance, that means already we need to pay 10, and this year's also, this is previous years. We need to pay this year's, again we need to pay this much. That means this, it has to be this much this year. So tax is 135 plus 10, 145. Net profit. We need to make the balance sheet. Have a look through this, please. So what is the point here is income tax remaining balance from previous year. That means they made income tax provision. If they see, let's say if income tax provision was, let's say, 100, let's say, and the year end provision for the previous year, I'm saying, see, previous year's opening provision was 100 and previous year's ending of the year income tax provision is estimated to be 90. That shows there is a reduction in provision 10, which will reduce the expenses. But what has happened is, if it is 90, there will be no balance left over. In fact, you made a provision of this much and you reduced it. But the point is, here they say that there is a remaining balance from the previous year. That means maybe the provision you made at the beginning of the year was 90, at the end 100. That means you made extra provision of 10, over provision. So what's that? Over provision. So actual tax bill, I can say, mm, I think under provision here. If you made over provision and you want it to restrict to 90, you reduce your provision by 10. But maybe you made 90 and your requirement was 100. At the end, you estimated it to be 100. So you made under provision. So now you need to make or add extra 10. Okay. So under provision of tax carried forward to this year. So what it will do, it will increase the income tax expenses very clearly. So how it happens, if we make the account also, it will be provision of tax by opening balance 10. Current year's income tax is nothing but income tax expense to income tax provision current years. So in income tax provision by income tax expense. So total is 145. Income tax charge or expense. So you clearly understood. Make a note of this. It's a under provision of tax. That means last year the estimated tax was like they wanted the tax to be 100, but they estimated to be 90. Okay, that means they estimated 90, but they understood that they have to end up by paying 100. So there was a under provision. So 10 has to be provided. So what happens? Over provision, under provision increases the expenses. Over provision decreases the expenses. See, in warranty case, we estimated 90. Now we want it to be 75. We want to reduce the provision. So 15, reduce the expenses. We took 15 and we subtracted from administrative expenses. Here, we estimated 90, but we want the estimation at the end of the year to be 100. We want the provision for tax to be 100. We made a under provision. Now we need to add more amount as to make it till 100. That's what they're saying. Remaining balance from previous year to be taken this year and this current year's 135 we need to add. Okay. And 145 is the income tax expense. Okay, we'll make the balance sheet directly. So non-current assets we calculated, you remember 182 was the total balance. Inventory, closing stock, receivables, no change, bank, no change, directly given the trial balance. So total of assets, share capital, you have to take retained earnings opening balance. $270. Share capital is 200. 270 plus current year's profit we need to add. What's the current year's profit? 352. Subtract dividends. 6. How much you're getting? Anything else to be added? $270 plus 352 minus 6, 616. Loan 80 already borrowed and provisions, has to be 75. So we remove the, we have, 90 was our provision, over provision was done. Now we want it to be 75. So we remove the 15. We reduce the provision by 15. So now the provision is 75. You remember that 3 I told now outstanding interest you need to add to the current liabilities. So 60 plus 3, 63. Tax liability, current year's tax liability or current year's made provision is 135. So now what happens? This, and this total to 1169. This is the total of equity and liability side. So balance sheet is tallied. I will look through this. Any doubts you can ask me. See, after doing this question, I would recommend you to do one thing today, afresh. Do this test your understanding question. A run company. It is very similar kind of question you need to do. Test your understanding one, test your understanding two. If you're not getting, you tell me. I will be, glad to explain you. And I've already given you a very good question, Wilson Company. Okay. Apart from, yeah. So you have to do that Wilson Company question. In the next coming class, we will take up more two questions, two or three questions we will solve. Then we'll jump to next chapter. Any doubts you can ask me. So under provision means, let's say we wanted to pay tax of 8, like 90, but we paid 80. So we didn't have money. So 10,000 was the under provision.